Hey everyone. Okay, if you're feeling that familiar knot of anxiety in your stomach right now, because summative test number 1 is literally right around the corner, take a deep breath. You are in exactly the right place. Today's explainer is designed to be your fast-paced, highly visual cheat sheet to absolutely ace the accounting fundamentals on your upcoming exam. We're putting a laser focus on one of the most heavily tested areas, assets. So, get your notebooks ready, keep your eyes focused, and let's lock in this knowledge. I know exactly what you're probably staring at right now. That super daunting whiteboard breakdown. We're talking 30 items, 35 points covering everything from the basic accounting equation to normal balances and business transactions. When you're cramming for a test like this, the sheer volume of definitions can feel completely overwhelming. But hey, we're going to break down the most critical component, the A in your assets equals liabilities plus equity equation, so you can walk into that exam room with absolute confidence. So here is your literal study syllabus for our review session today. First, the exam blueprint. Then, what exactly are assets? Next, current assets, followed by tricky receivables, non-current assets, and finally, your final exam takeaways.
Section 1. The exam blueprint. Okay, let's dive into this. Before we zoom in on the specific accounts you need to memorize, we have to understand the macro view of the accounting world your professor is actually testing you on.
Think about it. Every single transaction your business makes will ultimately fall into one of these 5 foundational buckets: assets, liabilities, equity, revenue, and expenses. This is literally the bedrock of your accounting equation. But today, we're putting a massive magnifying glass strictly on that very first golden coin on the left, assets. Because if you don't understand what an asset is, well, the rest of the equation simply isn't going to balance in your head.
Moving right along to Section 2, what exactly are assets? Let's transition into defining that very first and honestly most foundational element you'll be tested on.
All right, here is the formal textbook definition you need to commit to memory. Assets are properties owned by the business. Notice the emphasis there. They are not rented and they are not borrowed. They are a valuable resource with the potential to generate economic value. Now, to translate that into plain English, an asset is simply the stuff your business officially owns that holds value. That's it. If you borrow it, it's a liability. If you just rent it, it's an expense. But if you own it, boom, it's an asset.
Assets represent the true wealth of an entity on the balance sheet. And remember, they don't just have to be physical things you can actually touch, like a stack of cash, real estate, or warehouse machinery. They can also be completely intangible things, like patents, trademarks, or intellectual property. Honestly, whether you can hold it in your hand or not, if it generates economic value and you own it, it is an asset for sure.
Section 3. Current assets. Now, what's really interesting about this next slide is how we begin splitting these assets into 2 distinct categories based entirely on time.
Let's start with current assets. These are all the assets of a company that are expected to be conveniently sold, consumed, used, or exhausted through standard business operations within 1 year. Listen closely. I want you to highlight, underline, and circle that phrase "within 1 year." I'm serious. This is the primary trap professors absolutely love to use on multiple choice exams. If it turns into cash or gets used up in less than 12 months, it is current. When you're staring at a huge list of accounts on test day, you need to spot the current assets instantly. Here is your ultimate hit list to memorize. Cash on hand and cash in bank, your petty cash fund, accounts receivable, prepaid expenses like prepaid rent or insurance, your inventories or merchandise stocks, and marketable securities, which are just short-term investments you can sell quickly. Say them out loud to yourself while you study. Recognizing these titles instantly is going to save you precious time on the test.
Actually, let's briefly highlight one specific current asset that sometimes trips students up. Petty cash. Now, don't let the word petty fool you. It's still a super valuable asset. It's simply a small amount of cash kept physically on hand to cover minor incidental expenses. Like the spare change or small bills kept in a lockbox for a quick office supply run. Because it's highly liquid, it sits firmly in that current asset category.
Which brings us to Section 4. Tricky receivables. Alert! Pay super close attention here, because this specific pairing of accounts is practically guaranteed to show up on your test.
First up, we have accounts receivable. Basically, this is the balance of money due to your firm for goods or services that have been delivered but just haven't been paid for by the customer yet. So why is this an asset? Well, because even though you don't literally have the cash in your hand today, you legally own the right to collect that cash in the near future. It represents incoming economic value.
But here's the trick. You have to pair accounts receivable with its contra account, the allowance for doubtful accounts. Let's be real. In the real world, not every customer actually pays their bills. So this contra account nets against your total receivables on the balance sheet to reflect only the amounts you realistically expect to be paid. It's technically an asset account, but it carries a normal credit balance to reduce the value of your receivables. Do not let your professor catch you off guard with that one.
All right, Section 5, non-current assets. Let's move on and see how this builds, shifting gears away from short-term liquidity and diving right into long-term value.
Just look at these two concepts side by side. On the left, we have our current assets, the cash, the bank deposits, the things turning over really quickly. And on the right, we have a massive factory with a not-for-sale sign. This visual perfectly hammers home that crucial difference we talked about, the one-year boundary. Obviously, that factory isn't going anywhere anytime soon.
So, formally defined, non-current assets are a company's long-term investments and property for which the full value will not be realized within the accounting year. Think of these as the long-haul heavy lifters of a business's operations. You don't buy a factory to sell it to customers tomorrow, right? You buy it to facilitate your business for years to come.
So, what are the specific non-current account titles you absolutely need to memorize? First and foremost, property, plant, and equipment. You'll hear this widely referred to as PPE, or fixed assets. Then, just like with receivables, you've got a contra account to watch out for, accumulated depreciation, which is deducted from your PPE to account for general wear and tear over time. And finally, you have your intangible assets and your long-term investments, like long-term bonds or stocks in other companies. And we are at Section 6, Final Exam Takeaways. You've made it to the final stretch of our review session. Let's summarize the absolute core logic you need to bring into the exam room with you.
Let's test your attention right now with a quick mini pop quiz. If a business buys a delivery truck to use for deliveries for the next 5 years, is that recorded as a current or non-current asset? Think about the rule. It's going to be used for 5 years, which is well past our one-year boundary line. Therefore, it is absolutely a non-current asset, specifically part of property, plant, and equipment. Keep that one-year rule at the very front of your mind. Remember that assets equal ownership and value, and you are going to absolutely crush this section of the test. But remember, assets are only half the puzzle. How will your company handle the crushing weight of liabilities and equity on the other side of the balance sheet? Well, we'll tackle that next time. Good luck studying, stay focused, and I'll see you in the next explainer.